Is your estate plan optimized to pay the least amount of taxes to the government when you, or if you're married, when you and your spouse pass away? Do you know that some trusts can get assets out of your taxable estate very efficiently? In today's video, the third of a series, my colleague, licensed estate attorney Kevin Ducombe, and I will outline two very useful trusts to tax efficiently gift assets out of your estate: the Qualified Personal Residence Trust and the Grantor Retained Annuity Trust. We'll break down what they are, the benefits of using them, and lastly provide examples of how they help physicians. Hello everybody, and welcome to Wealth Matters for Physicians by Altfest Personal Wealth Management, the channel that provides key investing and personal financial planning insights to help physicians achieve their key life goals. Before I bring in Kevin, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, no commissions manner, while as a legal fiduciary, always putting our physicians' best interests first. As physicians, you'll probably also want to know that Altfest is the preferred wealth manager for members of the Medical Society of the State of New York, and the preferred wealth management education provider for both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, just to name a few of our medical association partners. As I mentioned, my guest today is Kevin Ducombe. Kevin is a licensed estate attorney, an MBA, and a senior financial planning and estate specialist at Altfest. Before joining Altfest, Kevin was a trust officer at Comerica Bank and most recently was a consultant to financial advisors at Commonwealth Financial. A final housekeeping note: this video is for educational purposes only and not intended as specific advice to any specific viewer. Before taking any estate planning actions, please speak with a licensed estate planning attorney in your area, as well as your wealth management advisor and your CPA about your specific situation. So Kevin, thank you very much for being with us today on Wealth Matters for Physicians.
Yeah, thanks for having me. I'm excited.
Well, great. Let's get right to it. So today we're talking about an additional two advanced estate planning trust strategies: the Qualified Personal Residence Trust, or QPERT, and the Grantor Retained Annuity Trust, or known as GRAT. So Kevin, what is a Qualified Personal Residence Trust in broad strokes?
So the QPERT, again, is sort of an irrevocable trust shell. You're going to transfer a personal residence into this trust, and then the trustee is going to manage it from that point forward. And you're going to define what happens to the property after what's called the initial term. So the initial term is important because there are some rules that we'll discuss in a little bit. But basically, you want to make sure you survive the initial term, and then at that point, you're going to transfer the asset to either a trust for your beneficiaries or outright to your beneficiaries. But the main point is that you're picking a private residence. So you can't choose some sort of income producing property or a property associated with a business venture. And you're also limited to only two of these. So some people will do their primary residence, some people will do a vacation home, and you could arguably do both if you're in a situation where that would be beneficial. But effectively, it's something that is used to leverage the value of your gift and just give you a little bit more bang for your buck. And I think we'll go into that in a little bit here.
Right. Well, yes, that's a nice segue, Kevin, because speaking of like bang for your buck, what are the main benefits of using a QPERT, or Qualified Personal Residence Trust?
Yeah, absolutely. So I might have just touched on it too, which is that there's really a big leverage, a big discounting opportunity. And that's because the QPERT is defined in the tax code, and there's some certain rules that you can follow that allow you to give a larger value property away for less exemption. So I think it might be helpful to kind of walk through a little example here just to sort of hammer home that point. So let's say we had a beautiful Hamptons beach home worth about $6 million. If you're a couple in your mid-60s and you're willing to do that 10-year term, if we use the rates that are applicable for December 2022, and it happens to be 5.2%, that would actually allow you to transfer the $6 million property through the QPERT for only $3.43 million of exemption. And if we're talking about a married couple, you kind of split that in half. Each of them uses only about 1.2 million or so. of each of their exemption. So it's just really a powerful opportunity to move a lot of value out of your estate without using up all of your exemption and saving that for other assets down the road.
Right, right, right. And I know another thing I'll just add, based on hearing what you've said in the past, is that people say, well, like, wow, how come I get to be able to gift out an asset worth $6 million for so much less? And the thing to remember is that when you gift an asset outright, immediately the people have it. Like if you give it to your children, they immediately own it. You don't own it anymore. But with the qualified personal residence trust, if I understand from what you've said and what you've written about, is that you are still have the right to live in it for a certain term. And because you have some retained interest or retained ownership, it's not a full $6 million worth of value that you're transferring immediately, but you're transferring a reduced amount. Do I have it correct?
Yeah, thanks. Apologies if I glossed over that a little bit, but that was that 10-year term. So, right, in my example, I'm saying they're willing to kind of hold on to it or retain an interest, if you will, for 10 years. And that's what triggers that discounting mechanism. And so it's applying those rates over a 10-year period and using that mathematical discounting to arrive back at well, you're really not quite giving 6 million away today. So we'll let you use only 3.43 million of your exemption. Exactly right. Yeah.
Thank you. Thank you. That sounds great.
Yeah.
And so sounds really nice. Sounds like a great idea. So what are the potential cons to be aware of before one goes out and creates a qualified personal residence trust?
Yeah, so there's a couple different things. One is that time period we were just discussing. So that initial term is very important when you're setting up your QPERT, because if you do not survive that term, the tax code rules will actually put the value of the property back in your estate. So it will be like you didn't create the trust at all, and that could trigger some estate tax consequences for you that you were trying to plan against. The other thing is, if you do survive that initial term, as we were just talking about, you have given the property away at that point. So you don't really have the right anymore to just show up and live there and treat it as your own. And so what the attorneys will kind of help you think through is that you might create a lease arrangement at that point. Now, the attorneys will again try to sell this as a little bit of a benefit in that it's setting up kind of an obligation to pay some money to your descendants, your beneficiaries, and that's just moving more money over to them, but it's not using any of your exemption, all that sort of thing. But let's say you put your primary residence in there and you want to continue to live there. It could get a little bit uncomfortable maybe in certain situations if you have to kind of pay rent to your children at that point. So there are some issues to think through, and we certainly hope that, through working with advisors like us or your attorneys, they'll definitely help walk you through some of those issues to consider.
Thank you so much, Kevin. It's really good to see the pros and the cons.
Mm-hmm.
So
absolutely.
Moving on to our next trust strategy for this video, what is a grantor retained annuity trust, again in broad strokes?
Yeah, so the GRAT is another irrevocable trust shell you're going to create. You're going to put a gift into it. In this case, you're going to define some sort of benefit you're going to receive back at that same time. So you can put 5 million in and say you're going to get 20,000 back for 6 years, or you can put 5 million in and say you're going to get 5 million back over 5 years or something like that. So it's just sort of a little bit of a push and pull, and it really goes back to some of the stuff we were just talking about, just working through kind of discounting and benefits of different amounts, annuities, and time periods.
So Kevin, I know there's another type of GRAT that you wanted to specifically talk about today, and that's called a zeroed out GRAT. It sounds interesting, but what exactly is it? And like in big terms, like what's the main benefit of it?
Yeah, so I kind of alluded to it. That's the GRAT where you're going to put as much in as you're going to get back. So the benefit is to be able to just move future growth out of your estate. And that's because the rules say if you're getting back everything you put in, you don't have to use any of your exemption. If you don't have to use any exemption, you're just moving all the growth out of your estate. So it's a nice feature for, let's say, very wealthy clients that maybe have used up all of their exemption through other strategies. They can continue to use these zeroed out grats to move more assets out of their estate that they won't then have to pay estate taxes on.
Great. And so could you walk us through an example of how one of these zeroed out grats work?
Yeah, absolutely. Let's take a look at an example here on this slide of Dr. John and his wife, Casey. They're ultra high net worth clients worth about $50 million. Dr. John's practice is pretty complex, and in particular, he's got some patents that he's developed over the years. So they've already used up all of their exemption, and they're thinking, what else can we do? They've got this zeroed out grat opportunity. So what they're going to do is Dr. John has identified this one patent in particular. It's worth $6 million today, but he's aware of some promising R&D that's in the works, and he really thinks in about 5 years, it could be worth $15 million. So what he's going to do is he's going to move that patent into the grat. He's going to set maybe a 6 or 7 year term. He wants to give a little bit of window to allow this increase in value to occur. But he's going to define it that he's going to get all 6 million back plus the interest rate here. And if everything goes according to plan, they're going to move effectively about $9 million, maybe a little bit more depending on the exact structure they go with. And that's going to be completely transfer tax free. So it's going to go to their beneficiaries. It's going to be out of their estate. When they pass away, no more estate taxes on all of that growth happen. Just another example where they're being proactive. They're taking the opportunity to look at something that they feel would be subject heavily to estate tax if they just keep it, but they have this opportunity to get it out and save a lot in taxes.
Great. Well, thank you so much, Kevin. That's an excellent example. And thank you so much today for being on Wealth Matters for Physicians. I think you've given a lot of useful things for our physicians to think about going forward.
Yeah, absolutely. Thanks for having me.
If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investment portfolio or a retirement readiness analysis, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video below. If you liked today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them also get their finances optimized. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please share your comments in the comments section below. Well, that's all for now, physicians. Thank you very much for watching today's video, and I look forward to being with you again in our next one. Until then, be well, and remember to keep on optimizing your finances, or let us help you if you'd like.